Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, member of the business development team here at iCM. And today we're here with an exciting announcement and news. And to share this great announcement is our Chief Investment Officer, Mike Paciotti, joined by our Director of Investments, Ryan Lehman. And we're here to celebrate the third anniversary of our very popular TICE Alpha Opportunities portfolio suite. Mike and Ryan, thanks for joining us and thanks for being here.
Great to be here, Pete.
So without further ado, I don't want to delay the momentous information that we're going to share today. Mike, for those that are joining us and watching here today that are either new to ICM or just may not know, do you mind talking a little bit about how TICE Alpha Opportunities, or TAO, came to be?
So sure. So as many of our listeners know, our roots are as value investors who make tactical asset class decisions via our quantitative process. So we've been doing that together at ICM really since our founding in 2009, and probably for a decade prior to that at various predecessor firms. So value investing, whether at an individual security level or at a top-down level like we implement, is really nothing more than a mean reversion trade. You have some estimate of fair value and something that is stretched from it and reliably returns to that fair value. That's basically value investing. So in the year or two preceding 2016, we started to become really interested in closed-end funds. They had, many interesting characteristics. They were inherently diversified. There were lots of them, and they had prices that deviated from the product's fair value, which was net asset value. So in addition, closed-end funds, when closed-end funds traded below NAV, yields were amplified. So you had diversified portfolios that captured market returns with pretty meaningful yields and the potential for an alpha source through capturing the movement of premiums and discounts. So this was really interesting to us due to the potential for both return enhancement and risk mitigation that could occur if we captured all those building blocks. So this kind of came together for us pretty quickly as we determined that closed-end fund premiums and discounts at a universe level were highly mean reverting and could be measured pretty much just like valuations. So now, you can't just buy discount closed-end funds, or that ultimately doesn't work. So we had to solve some of those types of issues. But once we got past that, TICE, our flagship strategy, was born with the goal of capturing double-digit returns with about half the risk of the market.
Yeah, and then just thinking about how TICE Alpha Opportunities or TAO came to be, the genesis for this set of strategies, it was really the result of a couple different things. So first, we had a good handful of financial advisors that were using TICE individually, but there were also a pretty large group that were actually blending it with our traditional ETF and mutual fund strategies to make it kind of more widely accessible to clients across the risk spectrum. So the 5 TAO strategies, they were directly meant to address this with risk profiles that are going to range from 1090 for our income opportunity strategy all the way up to our most aggressive 80% equity, 20% fixed income model. And then the one thing we had to consider, though, when we were developing TAO is that we didn't want to just offer an asset-weighted version of that flagship closed-end fund strategy, or TICE, because we ran the risk of limiting our opportunity set, particularly as you start to move more heavily into stocks and away from bonds. So to remedy this, we essentially combined that TICE strategy with a portfolio of our best ideas from our global tactical asset allocation model. And not only does this keep our closed-end fund opportunity set pretty robust, but it also adds this really unique type of diversification benefit. And that benefit is basically that closed-end fund cycles, they tend to run a bit shorter versus your longer-term value cycle for asset classes. So think about 18 months or so for closed-end fund discounts, versus typically 5 or even 10 years in some cases when you're thinking about the cycle for an asset class or for valuations for asset classes. And what this does is it allows us to draw on different sources of excess returns. So for instance, last year in the market drawdown, closed-end funds struggled exactly as one would expect, while those undervalued assets, they actually posted really their best relative performance in years. And then conversely, look back to that 2020, 2022 timeframe, And the situation was pretty much the complete opposite, where the closed-end fund portion of the portfolio really drove performance.
Great information. Mike, I'm going to jump to you for our second topic here. And obviously, as an organization, an investment organization, we're philosophically rooted in relative valuations when it comes to our investment process. Would you mind sharing a thought or two about the high conviction portion of TICE Alpha Opportunities portfolios, TAO portfolios, and ultimately, how would you describe the differences versus other strategies out there?
Yeah, so every money manager has ideas that they love, some that they like, and some that are just so-so, or perhaps they don't even like. But for the sake of diversification, most end up in traditional portfolios. So, with empirical data to support it, in the last 40 years, the average money manager owns 76% of their portfolio in U.S. equities, and this rarely ever changes, with the high being about 90% and the low being about 70%. So, is this really a reflection that U.S. equities are always the right answer? Probably not. Nothing's always the right answer. So, what if they aren't? And how much should you own just for the sake of diversification? Yet most professional money managers, as well as individual investors, own the majority of their portfolios in an asset class that they may not even like. So by contrast, diversification is tremendously worthwhile and a necessary part of investing. It solves many problems, not the least of which being saving us from ourselves. Remember, the Dow is littered with blue chip names that are no more. Enron, Kodak, and the list goes on, right? So our question was, can we do it better, right? The Tau high conviction sleeve really represents our very best ideas and only those ideas, right? But we remain very diversified. We just found a better way to diversify portfolios as we emphasize our very best ideas, that being through closed-end funds.
So great. So Ryan, on that topic, that transition, a truly unique component of our entire tactical income suite, whether it's TICE or TAO, is clearly our use of closed-end funds. Can you talk a little bit about how you would describe the opportunity set in closed-end funds? And, more importantly, can you speak to the intended impact on a portfolio that uses closed-end funds?
Yeah, absolutely. So in terms of the entire closed-end fund universe, if we look at your average discount today, you're going to find that is right around 7% or so. And to just put that into some historical context, the universe normally trades at a discount of around 4.5%, and you usually have a standard deviation of about 3. So this means you look at where you are today, you're just about one standard deviation undervalued at a universe level. And I characterize that as, say, pretty attractive, especially given the fact that if we look back to the end of 2020, you were trading at discounts as narrow as 1% below net asset value. But looking just back over the last few years, we're by no means as cheap as we were, say, in early 2020 around COVID, or even back in 2015, where discounts were much wider. That said, though, the universe is kind of unique at the moment. So discounts are going to be pretty widely by asset class. So, for instance, if we look at U.S. equity funds, for instance, they're only trading at discounts of about 4% below NAV, which is actually tighter than their long-term average. And then if we look at munis on the other side of the spectrum, you're going to see the complete opposite. So munis are currently trading at discounts in excess of 9% to NAV, which is nearly a 2 standard deviation event. So clearly much more opportunity on the muni side and fixed income in general compared to equities.
All right, so stop for a second. Talk to us a little bit about how that's going to translate into how the team is currently positioning the portfolio.
Yeah, so what we were doing for much of 2021, that was basically trimming positions and locking in gains as discounts narrowed. It's been much of the opposite over the last 9 months or so, where we've been opportunistically adding to our closed-end fund exposure. So if you were to look at our muni sleeve, you're going to see that's just about full within our TAO strategies as well as our TICE strategy. And then you're also going to see a good number of taxable fixed income closed-end funds as well in the portfolio. And just to put some characteristics around those closed-end fund holdings, We're currently seeing average discounts of just about 12% for the funds that we do own in TICE and TAO, and an average distribution yield of just over 7%. So I would say this gives the portfolio really a great starting point in terms of yield, as well as potential discount narrowing, while we still have some dry powder to be tactical if discounts do start to look more attractive in the future.
Great. I really appreciate the information, and certainly, underlines and underscores important points in why these portfolios have been so popular with advisors. For our last point though, Mike, I want to jump in and come back to you. What's the one thing that you would want someone to know about TAO going forward from this point?
So that's a good question. I get asked all the time, what's your single best idea? And I would say that TAO represents that single best idea, right? So you have so many things going for you with the elevated yield as a head start, discounts in closed-end funds, and large allocations to the most undervalued assets that we could find. For truly long-term investors, I think it's a great place to be.
Yeah, just to add to that a little bit, I kind of hit on this point already, but I just wanted to reiterate. I think one of the truly unique aspects of TAO is your ability to really benefit from those different sources of return at different points in the cycle. And that's really what's led to such strong performance since its inception. It was the closed-end fund alpha component that really led us out of COVID. And then it was really those undervalued high conviction assets that provided that level of downside protection in last year's sell-off.
Awesome job, guys. Really appreciate the time. Mike, Ryan, thank you for joining us for this exciting anniversary for TAO edition of Mic'd Up. For advisors out there that want to learn more about these portfolios and how to position them in client accounts, we're certainly happy to address any questions that you have. Feel free to reach out to us via email, info@icm-invest.com, or reach out to us by phone, 888-426-4689. We look forward to next month's edition of Mic'd Up. Thank you for joining us.